Hello, everybody, and welcome to a new episode of the Reinvent Money Hangout. I'm your host, Paul Buitink, and my co-host is lecturer and economist Jan-Willem Burgers. Our special guest today is no one other than Jim Rickards, author of bestsellers Currency Wars, The Death of Money, and now The New Case for Gold. Jim, warm welcome to you. Welcome.
Paul and Jan, great to be with you. Thank you.
Great. So let me just start with a few simple questions, possibly. If you could choose between going back to the gold standard or competing currencies, what would you choose?
Well, I think of gold as money, so to me, a gold standard is a form of currency. There's a lot of confusion about gold standards. Every gold standard is just a relationship between physical gold and some money supply. I don't expect people are going to be walking around with gold coins in their pockets. Maybe, if there's a breakdown of society, a breakdown of critical infrastructure, that may happen. But I don't necessarily foresee that. But just a normal gold standard, you'd still have paper money or digital money. It would just be backed by gold or linked to gold at some basis. On some basis, we had a gold standard. The pound sterling was backed by gold in the 19th century. The U.S. dollar was backed by gold through most of the 20th century, obviously up until 1933 or 1971, depending on whether you're talking about U.S. citizens or trading partners. So I don't think it's an either or. Do you have a gold standard or do you have another currency? The question is, have all the currencies you want, but have them backed by gold, as was the case under Bretton Woods and as was the case in the 19th century without the benefit of Bretton Woods. And that a system like that could work fine, keep central banks from inflating the currency, keep money honest, inspire confidence, and I think it would be an improvement over the system we have today.
But what if people want to use their own currency? Are they allowed to compete with the gold backed currency, or what's the situation like in terms of individual liberty and the possibility to transact in your own currency, backed or not backed by gold?
Well, look, anything can be money. At various times in history, feathers have been money, shells have been money, dollars, euros are money, Bitcoin is money, gold is money, silver is money. So there are many, many kinds of money. Some people say they're not backed by anything. Bitcoin's not backed by anything. The dollar's not backed by anything. But that's not true. They are backed by one thing, which is confidence. If you and I have confidence that something's money and we agree that it's money, then it can be money. So the question is, sure, you can come up with your own money. You can have some Paul money or some Jan money and put your face on the paper and print it up and hand it out. The question is, will anyone have confidence in it? Maybe they will, maybe they won't. Same thing with Bitcoin, same thing with gold. And so the question is, what is money? Money is any medium of exchange, unit of account, or store of value that the viability of which is determined by the subjective preference of the people who use it or are asked to use it. So I can call something money, but if nobody else in the world wants it, then it's not very useful as money. One of the attractions of gold, of course, is that it's always in demand, it's always acceptable, it's always been a good form of money. It's not the only form of money by any means. So I have nothing in principle against anybody inventing any kind of money they want. The only caution I would raise is, what are you doing to inspire confidence in your private money?
Right.
So what do you think are? Oh, sorry, Paul. What do you think are good competitors to gold as a currency? Do you think silver is a good competitor? Do you think Bitcoin would be a good competitor? Or do you think there are no competitors?
Well, no, I think competitor is a good way to put it. So think of it as a horse race, like our Kentucky Derby. You've got 14 horses lined up in the paddock, and they open the gates and they all run around the track and see who the winner is. So the horses are the dollar, the euro, the yen, the yuan, gold, silver, Bitcoin, other cryptocurrencies, UK sterling. These are the competitors. So who's going to win the race? Well, that would be based on the subjective preferences of users of money. People who need money or want money or have a use for money are going to decide individually which ones they have confidence in and how they will subjectively value them. So that's how money gets its usage, or gets its as I say, inspires confidence, or gets put into use. Now, governments have a little bit of an edge because this is now German monetary theory, but also called chartalism, which was adopted advocated by John Maynard Keynes. Governments have an edge because they can make you pay their taxes, make you pay your taxes in their money. So the U.S. says, we'll take dollars in payment of your taxes. So taxes are imposed by government. The U.S. government says we'll take dollars to if you want to pay your taxes, but we won't take anything else. I'm a U.S. citizen. I pay U.S. taxes. If I try to pay my taxes in gold, silver, or pound sterling, the IRS will laugh in my face. They only want dollars. So governments, through the power of taxation, have the ability to create some utility for their own currency because they make you pay taxes in it. That's not the only use for money, and you can have multiple forms of money. I could pay my taxes in dollars, which I do, but try to use gold or silver for other types of purchases. So, it's like I say, it's a race. There are many entrants in the race, a lot of horses in the horse race. They're all competing for, as I say, the preference of users of money for confidence, time, and usage. And may the best currency win.
It's interesting that you refer to German theory, and I think the modern money theory is kind of reviving this Churchill's point of view, where you say where they state that taxes drive money. It's also like Hyman Minsky once said that everyone can create money, but the problem is to get it accepted. And of course, the state, just like they did in old times with the tally stick, for example, in Britain, that the state first spends the currency into circulation and then accepts it back for taxes. And that's, of course, ensures that there's a lot of demand for that type of currency. So could we ever go to like a proper competing marketplace for currencies if governments have that advantage of making sure that there's always this demand for its own currency?
Sure. I mean, Weimar Germany in 1922, Zimbabwe 2000, Argentina 2000, Venezuela today. There are many, those countries print currencies and they collect taxes and they accept the currency in those in payment of those taxes. And yet, notwithstanding that, government power and coercion, confidence is lost in the money. There's capital flight, capital outflow, hyperinflation. So just because governments have a monopoly on printing their own money and a monopoly on taxation and use one to support the other, it doesn't mean that it always works. If confidence is gone, it's gone. So you'll take the money and get into, you might keep a little bit to pay your taxes, but you'll get into some other form of currency. I pay my taxes in dollars, but with my after-tax money, if I want to buy gold, that's up to me.
Yeah, interesting. And you also put a few arguments in your book that a lot of anti-gold folks would use to support the argument against gold, like, for example, that the gold supply isn't flexible enough or it can't increase fast enough to support world growth. What would you say to those people?
Well, that's a good point. I cover it all in my book, The New Case for Gold. Most of the book is pro-gold arguments, reasons to have gold, including some new ones which we can talk about. But before I get to that part of the book, I actually take these anti-gold arguments and I demolish them. Part of the reason I wrote the book, it's clearly educational. I'm not a gold salesman. You can't buy any gold from me. I don't get any commissions on this. But I wrote the book for educational reasons. But I was sick and tired after years of talking about gold, writing about gold, of hearing these arguments against gold that were not true. Now, people believe they're true. They've been miseducated or brainwashed or conditioned or uneducated, as the case may be, on the topic, and they hear these things, they sound good, and they repeat them, but they're not actually true. So let's just take the one you mentioned, Jan, which is there's not enough gold in the world to support world trade and commerce. So there's world trade and commerce, there are bank balance sheets, assets on banks, and people look at this big pile of money and credit, and they say there's not enough gold to support that amount of commerce. Well, it's not. There's always enough gold. There's always enough gold. It's just a question of price. In other words, at $1,250 an ounce, which is about the current price, if you took all the gold, multiplied it by $1,250 an ounce, that result would not support the money supply we have. You'd have to decrease the money supply to maintain that parity, which would be highly deflationary and probably depressionary, and would be an enormous blunder. But if you took the same gold and valued it at $10,000 an ounce and did the multiplication, there would be plenty of gold to support world commerce. So the issue isn't whether there's enough gold. The issue is, can you get the price right?
That was Churchill's mistake, right?
This was Churchill's blunder in 1925. And actually, the guy who told Churchill to have a higher price was John Maynard Keynes. Yeah, Maynard Keynes is always cited as this gold basher, but Keynes actually understood gold very well. Churchill wanted to go back at the sterling equivalent of $20 per ounce, and Keynes said no, that was the price before World War One. The Bank of England doubled the money supply to fight World War One. So if you want to go back to the gold standard with that money supply, you've got to double the price of gold, make it say $40 an ounce. Churchill ignored the advice, went back at the old price. They had to cut the money supply in half to maintain the parity, and that put the UK in depression 4 years before the rest of the world. So, and Churchill later admitted that was the greatest blunder of his life. But Keynes said, don't make gold $20, make it $40. Today, I've done the math, by the way. When I say $10,000 gold, I didn't make up the number. I'm not trying to get attention or headlines. I don't care about that. I've done the math. I know what the gold.
I care about headlines. But
okay, I know what the gold supply is. I know what the money supply is. I know what banking, fractional reserve banking is, and the answer is you've got to put gold in a range of, at the low end, $10,000 an ounce, at the high end, $50,000 an ounce, depending on whether you're trying to back up M1, M2, M3, depending on whether you're trying to use 40% backing or 100% backing. Those are all policy questions that people can legitimately debate, but just using M1, which is narrow, and 40% backing, which is kind of low, you get to $10,000 an ounce. That's the implied non-deflationary price of gold in a gold standard. So again, I see gold going there because there's no central bank in the world that wants a gold standard, but they may have to have a gold standard to restore confidence in some future financial collapse. And when you do, you're not going to repeat Churchill's mistake of 1925. You're going to get the price right, and the answer is $10,000. But the physical supply is no impediment. The other thing people say is, well, the supply of gold does not grow fast enough to keep up with the growth of the world economy. So, for example, mining supply, the supply of gold from mines relative to the total stock grows about 1.6% a year, and world growth, it varies, but it goes sort of between 3 and 4% a year. And people say, well, if gold's only going up 1.6% and world growth is going up 4%, the gold can't keep up, and that gives the world a deflationary bias. That analysis is complete junk. It's complete nonsense because mining output is irrelevant. There are 180,000 tons of gold in the world. Only about 35,000 tons are held by central banks and finance ministries to back up the money supply if they chose to. So if you want more gold, you don't have to wait for the miners to produce it.
And is deflation bad? Is deflation bad anyway? I mean, that's also the question you have to ask yourself before. Like, do we care if prices go down? And if we don't care, then any amount of gold would suffice as long as we can divide it in small enough quantities digitally in order to pay for goods and services.
Well, that's true, and deflation is good for citizens, bad for governments, but you're fighting the governments on this. But I'm just trying to take the argument off the table. In other words, sure, if gold did not grow fast enough, you'd have a deflationary bias, and deflation is good for consumers. I agree with that. But my point is that the mining output is not a constraint. You can have all the gold you want, just buy it from the private sector. Governments can print money, buy gold, add to their official gold supply, and then in the process of doing so, obviously they expand the money supply. It's just like printing money to buy bonds, which we do today, except in the future you would print money to buy gold, and again there would be no limit on the money supply. So there's nothing inconsistent about a gold standard and discretionary monetary policy. In fact, through the 20th century, the Bank of England and the Federal Reserve had both at once. We had a gold standard and discretionary monetary policy. So this argument that mining output is a factor, it's not a factor. That's an irrelevant argument. So I kind of go one by one and point out how all these arguments are fallacious. And then
where are all these arguments coming from? Because this is an interesting point you mentioned earlier as well, that all these central banks, they're all hoarding gold, but there seems to be this very negative attitude. Well, maybe not a let's just say not a very positive attitude towards gold, at least along the mainstream economists. But they're the same people that are also populating the central banks. So how do we explain this?
Well, if you had that much power, would you give it up voluntarily? In other words, the PhDs, the finance PhDs from MIT, Harvard, University of Chicago, Stanford, and Yale, who populate the central banks, not just in the United States, but around the world. I mean, Mario Draghi went to MIT. Draghi and Yellen studied under Stan Fisher, who's the vice chairman of the Fed. It's a very small group of people. It's like a PhD club, including Rajan, who's the governor of the Central Bank of India. governor of the People's Bank of China, they all went to MIT or Harvard. They were each other's classmates, each other's thesis advisors. They're running all the central banks in the world. They're the most powerful people in the world. They have a vested interest in disparaging gold and making you not think about gold or miseducating you about gold, because they want a paper money standard that they control. Anyone who controls the money controls political power, controls the economy, controls people's lives.
It's the funny thing that they disparage gold on the one hand, but on the other hand, most central banks have gold as one of their main assets. So in a way, we're on a shadow gold standard, but they're at the same time criticizing their own investment policy, as it were, because you cannot just say gold is bad on the one hand, and on the other hand, keep it as one of your main assets on your balance sheet, right?
That's right. I talk about that in my book, The New Case for Gold. You know, it's available on Amazon right now. I explain, look, the United States has 8,000 tons. The IMF has 2,000 tons. Germany has 3,000 tons. China has at least 4,000 tons, perhaps a lot more. Yeah. Russia has bought 1,000 tons in the last 6 years. Why are all these central banks hoarding and buying gold if it has no value?
Exactly. Yeah, and how do you look at these developments around people's QE? Because QE obviously isn't working as much as the governments want. And at the same time, we see a lot of different movements across the world that are advocating for people's QE, and there are even central banks now saying, yeah, we should start giving access to citizens straight to the central bank. In Ecuador, for example, as a citizen, you can already open an account with the central bank. The People's Bank of China talks about it. England talks about it. Holland talks about it. I don't think we're that far away from citizens being able to open an account with the central bank and have access to central bank reserves or digital cash, as it were, which would be possible then for people's QE to flow towards. How do you see that that development, and what is your view on these things?
Well, it's definitely coming. I mean, people's QE is sort of Jeremy Corbyn's term for it. He's the leader of the Labour Party in the UK, but it's really just helicopter money. We call it helicopter money in the US. We call it people's QE in the UK. The thought leader on this is Adair Turner, who is the head of the Institute for New Economic Thinking. That's a George Soros-backed think tank. Adair Turner has a book, it's called Between Debt and the Devil. He refers to something called debt pollution, debt monetization. It goes by different names, but it's all the same thing. And basically what it means is like the way we try to ease now, and it doesn't work, but the way we do it, quantitative easing. So the central bank goes out, calls up a commercial bank or a dealer and says, I want to buy 10-year treasury notes, and the dealer sells them the notes at a price, and then the central bank pays for it with money that comes from thin air. So I'm the Federal Reserve. I buy treasury notes from the dealers, and I pay for the treasury notes with money that comes out of thin air that I just print. But the problem is the bank now has the money because they sold me the bonds. They take the money and give it back to the Federal Reserve. They give it back to the central bank, and it sits there in the form of excess reserves. So the money doesn't get spent, it doesn't get lent, it doesn't create velocity, it doesn't turn over, it doesn't add to aggregate demand, it doesn't do anything. All it does is suppress interest rates, enrich bankers, deprive savers, and in theory, create some kind of channel what they call a portfolio channel effect to get people to buy stocks. That just creates asset bubbles. So that's the way quantitative easing works. Helicopter money is a little different. You start with fiscal policy, so the government just spends the money. They can give it to people. They can spend it on Medicare, Medicaid, Social Security, welfare programs, education, the environment, or they can spend it on defense or infrastructure, highways, bridges, whatever. The bottom line is the government spends the money. That increases the deficit. The finance ministry or the treasury then issues bonds to cover the deficit, and the central bank buys the bonds, thereby monetizing the debt. So you're combining fiscal policy and monetary policy. Fiscal policy to create larger deficits and more debt, and then monetary policy to buy the debt. That's called debt monetization. Now, in theory, you're still printing money, but now the money at least is getting spent. It's not being deposited back in the banks, and that, in theory, creates aggregate demand. Let's see. I think that's just increasing your debt to GDP ratio, putting you further down the road to the path of Greece, destroying confidence, making. But
Greece can't issue its own currency. The states they're buying up their own bonds with their own currency. So in a way, in nominal terms, they will not default because they're always able to buy up their own bonds. But with their own money. But Greece, of course, is in a different situation where it cannot. It's basically on a gold standard, but then in euro terms.
Sure, but the fact remains you can still run budget deficits and spend the money to try to stimulate the economy. Now you're right, Germany is standing in the way of them doing that, but in theory, any country in the world, including Greece or particularly the United States, can run budget deficits, assuming Germany's not squashing you. But the point is, certainly the UK, Bank of Japan, Russia, China, the United States, Canada, all have degrees of freedom to do this. China's talking about it. They call it fiscal stimulus, but as long as the central bank monetizes the debt, then the money gets spent, and in theory it helps the economy. But I'm very doubtful that that's the case. I'm not sure the multiplier is really there, and the destruction of confidence in the bond market and the currency as a result of the increased indebtedness and higher debt to GDP ratios may do more harm than good.
How damaging do you think? What do you think the situation is currently at central banks? So central banks are, of course, a bit different than regular banks. But if you look, for instance, at the balance sheets, the sort of liability side has exploded in let's say the last few years or so. What's your take on this? What's the health of our central banks at the moment?
Well, I'll use the Federal Reserve as an example. That's the one I'm most familiar with, although the same basic story would be true at the Bank of England, the Bank of Japan, the People's Bank of China, and the ECB, all the major economy or economic grouping central banks. So a typical bank is leveraged, good, healthy commercial bank is leveraged about 12 to 1. Under U.S. law, a broker-dealer is leveraged about 15 to 1. A good private equity firm might leverage 6 to 1. A hedge fund might leverage 3 to 1. The Federal Reserve is leveraged 113 to 1, right? So all the other ratios are 12, 15, whatever to 1. The Federal Reserve is leveraged 113 to 1 with a serious asset liability maturity mismatch. So the Fed looks like a really bad hedge fund. I talk about this in chapter 1 of my book, The New Case for Gold. I describe the Fed's balance sheet, and I speculated that if you took the bond portfolio and marked it to market at certain times, not all the time, it depends on the level of interest rates, but at certain times the Fed would be technically insolvent, and I identified times like that. And I spoke to one of the members of the Board of Governors, one of the Fed governors, about this, and this person told me, first denied that they were insolvent and then admitted they might be, and then finally said, well, what difference does it make? In other words, central banks don't need capital. I'm not so sure that's true. Right. In a crisis of confidence, they might very well need capital. But the point is, and then I talked to another, I talk about this in the book, in chapter 1 of the book. I spoke to another Fed insider, not a member of the Board of Governors, but actually somebody who's even more of an insider, one of the closest advisors to Ben Bernanke and Janet Yellen, and he was very adamant, very firm with me that the Fed has never, ever been insolvent, regardless of the mark-to-market on the bond portfolio. So that forced me to go back and examine my assumptions, look at the balance sheet, and see what I might be missing. And I discovered that the first line actually on the Fed balance sheet is a gold certificate. That was given to the Federal Reserve because the Treasury confiscated the gold from the Federal Reserve back in the 1930s. But the Treasury is the government, and the Federal Reserve is a private institution. And under the Fifth Amendment to the United States Constitution, it's unconstitutional for the government to seize private property
That's interesting.
without giving compensation.
Okay.
So the compensation that was given was this gold certificate backed up by the Treasury that the Fed still has on its balance sheet. Now here's where it gets interesting. They value that certificate at $42 an ounce, $42 an ounce of gold. Wow. Now, obviously, gold is $1,250 an ounce. That's historic cost accounting because it was $42 an ounce the last time they marked it to market. But take the dollar value on the balance sheet, divide by $42, that will give you the number of ounces. I converted that to tons, and lo and behold, it came out to almost exactly 8,000 tons, which is exactly the same amount that the Treasury has. The Treasury has 8,000 tons. Mm-hmm. So it's clear that the U.S. Treasury cannot sell any more gold because the Treasury needs the 8,000 tons to back up the 8,000 tons that the Fed says they have on their balance sheet. So secretly, and if you actually mark that to market, mark the gold to market, and add it to capital, it turns out the Fed is only leveraged 13 to 1. So the Fed looks like a very healthy commercial bank with a very decent capital base and a very decent leverage ratio if if you count the gold at the market. So the Fed is being propped up by the gold. No one will talk about this. No one will admit it. But the solvency of our Federal Reserve is propped up by gold, held by the Treasury, but nobody wants to talk about it.
Yeah. For just a quick message to the viewers out there, thanks so much for listening to this episode and also supporting our channel. Please like the video and subscribe to the channel. Jim, I know you only have half an hour, so we already kind of need to wrap up, but you said something interesting also in the book, that there's this new argument for gold that wasn't there back when the original case for gold was made, which relates to our digital world. Could you elaborate on that argument a bit?
Sure. You know, the title of the book is The New Case for Gold, and a lot of people have said, well, what's new about it? I mean, the arguments pro and con about gold have been going on for decades or maybe even centuries. What's new? Well, there are some things that are new. I do talk about the old arguments, so I go through all of that in the book. But one of the new arguments, there's several, but one of the ones I found most compelling is that Vladimir Putin has a 6,000-member cyber brigade. These are not criminal hackers. These are U.S., Russian military and intelligence assets working night and day to hack, disrupt, delete, destroy, and erase all digital banking, financial, and capital markets records. So you could tell yourself, you know, I've spoken to billionaires who say, well, I own stocks and I own bonds, I own this and I own that. And I say, no, you don't. You don't own stocks and bonds. You own electrons. All of your wealth is digital. And if it's erased, you have no wealth at all. You're wiped out, and that could happen in a heartbeat. And don't think it can happen. People think, when I say things like this, people think it's, you know, science fiction or I'm making things up. No. Just last week, Bangladesh, one of the poorest countries in the world, lost $100 million that they had deposited with the Federal Reserve Bank of New York. It wasn't, you know, deposited in some bank in Sri Lanka or India or Bangladesh. It was at the safest bank in the world, the Federal Reserve Bank of New York, and the $100 million simply disappeared. The point I make, that can happen to you. So you need to have some of your wealth in physical, tangible form. And I like physical gold. You can't hack it. You can't erase it. You can't delete it. Vladimir Putin cannot get to it. If Bangladesh had gold, they'd still have their $100 million today. So I don't recommend going all in. I'm not saying sell all your stocks and take all your money out of the bank and go 100% to gold. I don't think you should be 100% in anything. But a 10% allocation of your investable assets will preserve your wealth, and it can't be hacked or erased. So we weren't talking about hacking and erasing and cyber financial warfare on the internet. We weren't talking about that, you know, 10, 20, 30 years ago. This is a new 21st century reason to have gold, in addition to all the other reasons. And again,
would you still advise people to own some Bitcoin as well?
Well, no. I mean, Bitcoin's digital. If the power grid goes down, your Bitcoin are worthless. So I don't. I'm not anti-Bitcoin, but I see it having a lot of the same vulnerabilities. But physical gold does not have the disabilities of Bitcoin and digital currencies like the dollar.
Yeah, and then we're in a political year. I think, Jan Willem, you had a final question for Jim before we wrap up about U.S. politics. Maybe you can drop that.
Sure. Yeah, I was curious, Jim. What do you? So I think you predicted that there would be a recession this year. I think we're already seeing maybe some of the signs of that coming. What kind of consequences do you think that's going to have on the U.S. Election cycle that we're currently in, on the presidential elections?
Well,
and how do you think the different candidates might respond to a financial crisis? Do you have any preferences?
Well, you know, every forecast is conditional, and I use inverse probability and Bayes' theorem, so you're constantly updating. And you're absolutely right. Before December, in anticipation of the Fed rate hike, which I said they would hike in December, after having said through all of 2015 that they wouldn't hike. Remember, go back to March, June, September 2015, Wall Street was saying the Fed was going to hike rates, and I said they wouldn't. But in December, I said they would. I also said it would be a blunder, and it would cause markets to collapse, and that's exactly what happened in January and February. But then the Fed got scared, and obviously they're being extremely dovish now. But the point is, the recession forecast was based on the Fed sticking to their rate hike path, which they laid out in December, which was 100 basis points per year. But Janet Yellen is a very well-known liberal Democrat. She's a Democratic labor economist, and The people around her, Lael Brainerd and mentors like Bob Rubin, others, they're all liberal Democrats. So I call her a pod person now because they obviously got to her and switched her brain. And she's being extremely dovish right now. So I think her dovishness is to help the Democratic candidate because they realize that if they continue to raise rates, they would put the U.S. economy into a recession. I still think there's a good probability of a recession, but if we don't have one, it's only because the Fed backed away from their own tightening policy, probably for political reasons to help the Democrats.
Okay.
Right, Jim, where can people find and buy the book?
Thank you. The book is called The New Case for Gold. It's available right now on Amazon, so just go to Amazon.com. It'll be in bookstores, at least in the United States, next Tuesday, April 5th. But you can order it right now on Amazon. I hope people get it and I hope they enjoy it.
Right, and has a great review also from Ron Paul, right?
Correct.
Yeah, perfect. Any closing remarks from your end, Jim?
No, it's an ongoing story, and again, I wrote the book really for educational reasons. Like I say, I'm not a gold salesman, but I wanted to knock down the arguments against gold that don't hold water. I wanted to lay out the case for gold, and I wanted to include new matter that's why we call it the new case for gold, because there are 21st century reasons to have gold. Don't have all your wealth in digital assets because it can be frozen or wiped out in a heartbeat.
Yeah, or do like me, a little bit of digital assets, a little bit of gold, and you're fine.
I think that's right.
Okay, great. Thanks, Jim, and let's do it again when your next book is out.
Thank you very much.
Okay, bye.
Bye. Bye.